Welcome. My name is Van Richards. I'm a chartered financial consultant, and I am here today to educate you on how to identify stocks that can help you accomplish your financial goals and meet your financial preferences. I think that you're going to enjoy learning about the company that we're talking about today. This company's name is Zoetis, and you're going to enjoy, I think, what you're going to learn today. So let's go ahead and begin with today's daily stock analysis. Welcome and thank you for joining me today. If this is your first time and you're watching on YouTube, go over and hit the subscribe button, hit the bell so that you get notified when there's new content that is put on the web. If you're listening to me on a podcast, make sure that you follow me because I have regular content that I think that you're going to be able to use a lot. The company that we're going to talk about today is Zoetis. And the way that I got introduced to Zoetis is by one of my best friends, which is my dog. And Zoetis is an animal health company. And there was a time when I had friends of mine that had dogs that had health issues, and they spent a lot of money on their dogs. And I thought, I'm never, ever going to spend that much money on a dog. It just will never happen. Well, guess what? It happens. And I utilize some of the products from Zoetis, and I've become familiar with the company and what they do. And I think that you're going to enjoy learning a little bit more about how this company operates. But before we begin into the nuts and bolts of the way that the company works, what I want to do is introduce our first sponsor, which is Richards Financial Planning. Richards Financial Planning is my firm. And if you are frustrated with your finances and you're trying to get things going in the right direction, and you live in Texas, because that's where I do my individual business, go over to richardsfinancialplanning.com and learn about a process that I created, which is called the Prosperous Planning Process. I think you'll benefit from it a lot. All right, let's go ahead and begin talking just a little bit more about how I developed the discussion today with Zoetis. And the way that I did it was I was asked to put together an individual ETF for a client. Now, as you know, ETF stands for an exchange traded fund. Well, when you do it individually, it's not really an exchange traded fund, but it is a focused fund. And what this person wanted is they wanted a pet care veterinary type fund, a variety of investments that would fit their criteria. So what I did is I did some search. There are some companies out there. Actually, I believe there's one called ProShares that does have a pet care ETF, but it really didn't fit the criteria of what we were looking for. We were looking for something that was very focused. So I'm going to show you a list of the companies that I put together for this client. And the companies that you're seeing on the screen right now, if you're just listening, I'm going to read them off to you really quickly. There's Zoetis, which is the largest company, Chewy.com, IDEX, Elanco, Freshpet, Covertis, Trupanion, Central Garden and Pet, Heska Corporation, PetQ, and PetMed. Now, I want to emphasize this. I'm not here to recommend to you to buy any of these particular investments, but this is the way that I put together a ETF for a client or a focused portfolio. And this portfolio's history is actually done very, very well. It's dominated really by Zoetis, with about 38% of the assets that are in that particular stock. And the reason they're in that stock is because it's the largest company. Then you get to Chewy.com. But I want to show you something. This is what I found out when I put the model together. And what I'm putting on the screen right now is all of the stocks that I just mentioned, the 11 or 12 stocks that I just mentioned, compared to the S&P 500 over the past year, over the past 12 months. Now, over the past 12 months, if you make this just a little bit bigger, what you're going to find out is that the companies that I selected have done in the past year over 100%. I was shocked when I started developing this portfolio for this client. It would be wonderful if it would repeat that in the coming year, but I'm not going to bank on it. Last year was pretty good for the S&P 500, where it was, in between 15 and 20%, but the pet care portfolio that I designed had over 100% return. And there's a few stocks that made it go up and dominated it. And Zoetis is one of them. But look, I have to put it up in big red bold letters because, friends, even though that this portfolio that I designed had an amazing past year, the past performance cannot be an indicator of what the future may hold. But let's learn a little bit more about the way that Zoetis is designed and the way that the company works in itself. Zoetis really is the world's largest animal healthcare company. 56% of its revenues come from their companion animal division, with another 44% coming from their livestock division. Primarily, they are in the United States, but 43% of its revenue comes from international sources. A small portion, 6%, comes from the emerging markets, but is primarily in Australia, Brazil, Canada, Chile, China, France, and the list goes on. It's in Germany, Italy, Japan, Mexico, Spain, United Kingdom. They're truly a worldwide company. It is the largest animal healthcare company. Their valuation right now is at about $75 billion, give or take a little bit. They had a pretty good day in the market. They were up 0.49% at $160.62. Now, when we look at a stock, I remind you of this every day when we go through stocks and we look at the stability, the earnings, and the competitiveness of all the stocks. And in my opinion, my humble opinion is, if you can find a stock that can meet all three of these three criteria, then you've identified a stock that's a pretty good stock. Now, the first thing that we do when we start looking at the stability, we want to talk about the moat characteristics of a company. And remember, that moat is the barrier, that invisible barrier that's between the company that sets them apart from their competition. And one of the biggest things that this company has going for it is its proprietary assets. That would mean that they have different drugs that are very difficult to replicate, and there is not a generic equivalent. Two of them I've personally used. One of them is called Apoquel, which is for my dog's itching. And believe me, it's not cheap. It's about $100 a bottle per month, depending upon the amount that you give to your dog and the size, or cat, whatever your pet is. And then the other one that I've utilized, or through my vet, is called a Cytopoint injection. And that was about $100 and some bucks just for one shot. So its proprietary assets are significant. They have a cost advantage because they're able to develop drugs from their company where other companies could not. And that cost advantage makes it into a size advantage, which is the fourth characteristic. But there's also a switching cost which is involved. Vets are going to be very hesitant to switch what they're recommending when they have something that's working. It's kind of like you. If you've got a medication that's working for whatever ailment that you might have, you're going to be pretty hesitant in switching it. And the same thing's going to happen with your pet too. Now, the one big benefit that I see with this company is that they have a fragmented customer base. Now, if you're one of their customers, you might not be a big fan of this characteristic, but if you're an investor, having a fragmented customer base is a significant advantage. Now, what do I mean by that? What I mean is that pet owners, farmers, ranchers, and veterinarians, they have very little price negotiation ability with large animal healthcare companies. And the fact that their customer base is fragmented really means that Zoetis can control the price of the drugs and the services that they supply to their customers. Let's take a look at their history. Now, I really think that this company is more recession-proof, and I think that you'll see what I mean when we look at this. I know that they're going to be coming out with another earnings call, which is actually next week. And the reason why I wanted to do this week is because it's a really good thing to take a look at where you are, because after they announce what their earnings are, that's going to immediately affect the market. So people that are looking at this stock today may be asking themselves, what's going to be next week? If next week continues the trend that you're going to see, then you could possibly see a price increase, and we're at a lower price right now. If not, then it would go down. For the first 9 months of 2020, they had earnings of $4.8 billion compared to 2019, which was at about $4.5 billion. That's an increase in that 9-month similar time period of about 6.15%. As we go a little bit further into this and we look at their actual third quarter revenues in 2020, that's the one that was prior to the end of the year. The third quarter, it was 1.7 billion. That's an increase over the 2019 third quarter revenues at about 1.5 billion. Actually, it's a 12.75% increase, which is really good. Now, the next thing that I want to look at is diluted earnings. And I had someone that asked me, they said, why should I consider diluted earnings? What's the difference between their regular reported earnings and their diluted earnings? And this is the answer. The diluted earnings measures the real value a company has earned per share. Now, they may have different types of securities, which are called convertible securities. And if all those were exercised, that means if they were all basically converted into common stock, then that's what the earnings per share would be. And they're going to take into consideration outstanding convertible preferred shares, convertible bonds, and stock options. Now, what that basically means is it's a level playing field. We're just talking about regular old common stock rather than all the other different types of things that are out there on the stock. So that's why we use diluted earnings rather than regular earnings. And that brings it to the point of looking at the first 9 months of the year. Last year in 2020, their diluted earnings for 2020 was $2.67. And that's actually up from $2.31, up actually 15.58%. So here's the big question, ladies and gentlemen. Is that going to continue when they do their quarterly earnings report next week? If they really went beyond it, that you could see their stock take off. If not, then the stock would have a problem. So you have to ask yourself the question that if you're going to be investing in this stock currently, should you invest before the earnings are reported, or should you reinvest after the earnings are reported? Now, most of the analysts out there are having good expectations for Zoetis. If we go back to 2014, if we look at what the earnings were, they have had, this is a beautiful graph. If you're just listening on the podcast, I hope sometime you'll go over and watch the video, because when you get to this point, you're going to see earnings on a quarter by quarter basis that have increased. And the expectations that analysts have for Zoetis going forward are very, very good. But look, we have to always throw this part in there. The past performance of a stock is not going to be a guarantee of what's going to be happening in the future. But it's real good to take a look at, see what happened in the past. So let's get in the Wayback Machine and go back a year. A year ago, this stock was trading at $141.72 per share. They ended today at the 160.62. When I did this around lunchtime, is at 161.37. In a year, it's up over 13%. Now, what do you see on the spaghetti graph that's in front of you? There's a couple of other things in there. Zoetis is the line that's in blue. The one that's in red is the NASDAQ. That's actually the NASDAQ 100, the top 100 stocks in the NASDAQ. Now, as you well know, the NASDAQ 100 is dominated by tech companies, the FANG companies. But I wanted to show you that you can have a company as an investment that's particularly not a tech company that can do very well. And that's actually Zoetis. Now, you may be looking at this and thinking, yeah, but the NASDAQ 100 did almost 45% last year, 13%, 45% is a big difference. Well, let's go back 3 years, because 1 year does not make a good stock. for the long term, that is. When we go back 3 years in the Wayback Machine, we can see that Zoetis' stock was worth about $71.89, maybe a little bit more, actually, at 71.891. When we look at what it came out today, it was up over that 3-year time period, 124.46%. That's an APR, annual percentage rate increase, of 30.93%. In a 3-year time period, this stock beat the tech-heavy NASDAQ 100 significantly. Now, when we compare it to the S&P 500, which is the green line that you see, the green line is good, but Zoetis actually beat the S&P 500 and the NASDAQ. But we always have to throw this part in, friends. The past performance of a stock can't be a guarantee of what's going to happen in the future. Now, a good indicator is to actually look at what the company says they think may be happening in the future, and then also look at what the analysts are saying they think is going to be happening in the future. Now, Zoetis' 2021 outlook is that they are expecting 7 to 8% revenue growth, and analysts on average are actually saying that it's going to be better than that. They're estimating that it will be in between 8 to 9.5% in the long term. But I want you to remember something, that outlooks are not guarantees. Okay, now let's get to a really good part. I love dividends in stocks, and this is not going to be a huge dividend, but it's respectable. It's at 0.63%, and actually that's a 25% bump over last year. What Zoetis has tried to do every single year since they have come out from an IPO, I believe it was 2013, they've tried to increase their dividends on a regular basis to show some stability to the company, which is actually a good characteristic to have going forward. But remember, I have to stress this. I know I sound like a broken recording, but the past performance is not going to be a guarantee of what the future results are going to be. But that brings me to my second sponsor, and that is a guarantee. This is our second sponsor, which is Advice for Life Insurance. Advice for Life Insurance. You need life insurance. Protect your family with life insurance from adviceforlifeinsurance.com. You can find the best life insurance at the lowest price in less than 5 minutes. Okay, let's go ahead and begin talking a little bit more about the bulls and the bears today and what they're saying about Zoetis. When we look at what the bullish analysts are saying, we're going to go back to the thing that I talked about as far as having a fragmented customer base. They have cash payers. In other words, when you have a pet, or if you have livestock, you pay that vet in cash. You don't have insurance. There is insurance companies that do cover pets and do cover livestock, but it's not predominant like it is for people. Primarily, it's cash buyers. That customer base that's fragmented is a bullish characteristic, and there is minimal generic competition. The other thing to consider is this: continued FDA scrutiny of antibiotics in our food chain is going to increase the value of alternative therapies. When I took my dog in and he was having allergy problems, yes, they used an antibiotic first, but they went from the antibiotic over to a specialty drug, which was called Apoquel. And that may be the same thing that's happening with that 44% of the company's revenue source, which is livestock. That livestock, if it's laden with antibiotics and it's in the food chain, it actually hurts human beings in the long run. And the FDA's involvement in that is going to make alternative therapies much more popular. Pet owners are also much more willing to spend money on their pet health care. And I just want to talk to you about this one for just a second, because I found this very interesting. There's a great video which is referenced in today's show notes, which is a video interview of Kristen Peck, who is the CEO of Zoetis. And it's an interview with Jim Cramer. And she pointed out a couple of different things, and that is this. One is that because of the pandemic, we've seen about a 15% increase of adoptions from pet shelters. That's a wonderful thing. So there's not as many pets being euthanized. Now, people that have those pets, since they're staying home because of the pandemic phenomena, they're more around their pets, their dogs, their cats, whatever their pet's going to be. And they may be noticing that that dog doesn't get up quite as easily and its arthritis is bothering it. Well, guess what? Zoetis has an arthritis treatment. So you take your dog to the vet. The vet recommends that you use a Zoetis product. People are more willing to use pet care, pet veterinary products because they're around their animals much more. And that's a really big advantage. So it's a bullish characteristic, but everything's always not rosy. We have to also look at the bearish aspects of any particular stock too. And there are a couple of bearish aspects. The other thing that I mentioned, a minute ago when I talked to you about the antibiotics and the food chain, well, look, Zoetis also makes antibiotic products. So that may actually, that is FDA involvement into the system, into the distribution system through drug companies like Zoetis may actually hurt their growth. The other thing is that you saw in the very beginning video that there's only a 6% amount of the company's revenue that's coming from the emerging markets. And one of the biggest reasons is they can't afford these drugs. The margins in emerging market countries limits the growth of the company because they can't charge as much money as they do in developed companies. The other thing is, if you go back and you look at the list of all the different companies that I put in that personal ETF that I created for a client, you'll see that there's a company which is called Heska. Heska also does drug development. Drugs that are generic drugs and alternative therapies can compete with what Zoetis does. So they're not the only company out there. They're not the only one that's around. So now let's actually look at what the valuation is on this and talk about what some of the analysts are saying about valuation. And the first thing I like to start with is Morningstar. I like Morningstar because they have a good conservative track record of identifying what the actual fundamental value of a company is. Now, they rate this company as 2 stars. They have a star system that goes from 1 star to 5 stars. And it's different than it is with the mutual funds. I'm going to say that again. Their 5-star system is not the same as if you had a 5-star mutual fund. It's not the same. Generally, it's going to be based on valuation of what they feel that the true market value is going to be. Now, currently, we have the value at about 161.37. Actually, today it ended at 160.62. And what Morningstar is saying is they think that this stock is only worth about $125. So in their opinion, it's overpriced by about 29%. Now, does that mean that it's a bad stock? No, not really. What it means is that you just need to be cautious of when you buy the stock. In other words, if you think next week that when they do their earnings call that it's going to have better results than what most analysts say, then yeah, today's a good day to buy the stock. If you think that this is not going to be a continuing trend, then we could see it go down. That would actually make the stars go up. And that does happen pretty regularly. Now, what are some of the analysts saying that are following this particular stock? There's 16 analysts that are issuing opinions on this stock. That means that there's 16 analysts that have issued an opinion in the last 90 days. Out of that, 9 of those companies have said that Zoetis is actually a strong buy, and only 7 of them said that they're holding on the stock. Now, let's take a look a little bit further at what the competition is with the company. Now, when I talk about competition, I'm going to talk about it in 2 different ways. One is going to be compare Zoetis to other companies. Now, Zoetis was actually spun off from Pfizer, so we have to compare it to other companies that have drugs that are useful with animals. You have to understand that some of the drugs that you use as a human is also used in your pet. So when we compare it to other publicly owned companies, we're not only going to use a company like Heska that primarily makes just animal drugs, we're also going to compare it to Eli Lilly and Merck because they make drugs that are used in animal care also. Now, if you're looking at this on the screen and you're following on YouTube, you're going to see a spaghetti graph. And you'll see actually the most profitable company over the past year has not been Zoetis. Zoetis has been consistent. All the stocks took a big hit back during the, get that out straight. They took a big hit during the coronavirus market crash height or low that went on in between February and March. All of them did. But how they recovered is identified here by what you're looking at in the spaghetti graph. You can actually see that Heska did better than most of these other companies. Heska actually had over 200% rate of return in the past year. And maybe we'll look at that company in itself on another particular day. But Zoetis did pretty well. Eli Lilly had a great year. Merck had a fair year. But when we draw it back just a little bit further, we're going to look at it from a different perspective. We're going to compare it to all the companies in the sector, and we're going to compare it also to the U.S. economy. This is something that's a little bit different than I put up here in past reviews, because what I want to do is make a broader competitive argument for this particular company. Now, Zoetis, if we look at it in a 1-year time period, now, if you're following, just follow the cursor. If you're listening, I'm going to describe it to you. In the past 1-year period that's reported in the graph that you're seeing in front of you, Zoetis had a 15.82%. Now, if you compare that to the drug manufacturers who are specialty and generic drug manufacturers, that index, that sector had a 12.09%. If we compare it to the total U.S. economy, it was at 22.15. If you want to see more of this, go to the video and you can see the 3, 5, and 10-year numbers also. But let's keep going on because we want to talk more about what the individual analysts have said. Today, ending at $160.62, how does that compare to what some of the other wirehouses, some of the other analysts are saying that they think is going to be the future of this particular stock? And the most pessimistic analyst out there is from Truist Financial. And Truist is actually saying that they think that Zoetis has hit its peak. They're thinking that the limit is right at about $160. Remember, today is at $160.62. The most optimistic view on this is coming from Barclays. And Barclays is saying there's a lot more room to grow on this company. They're looking at a price in between $175 and $189. So you have to determine for yourself, how's this going to fit into your investment criteria? How is it going to help you? Is it the type of stable company that you're looking for, or are you looking for a company that has more risk maybe? Is its earnings acceptable to you, and how does it compete? Hopefully today, what I've been able to do with the information that I've given to you is I've helped you to identify these 3 characteristics. And that's what we do every day. We look at the stability, the earnings, and the competitiveness of a stock. And I think that if you identify those 3 things, that can help you to identify a stock that will fit your financial preferences and your financial goals. Thanks a lot, friends, for listening today. Continue to write into me with your questions. There's been some great questions, and it's just not about a particular stock. When I did the review of Munich Re, there was somebody that wrote in and said, how in the world can Munich Re have a payout ratio on dividends of over 100%? Well, go over to YouTube and you'll find out what my answer is to that, because I've gave what I think is a good answer. And I try to help you with different questions that I can. Now, I can't tell you if you write into me and you say, hey, do you think that GameStop is going to go up? I have no idea, but I can help you with some of the technical aspects, some of the fundamental answers, and help you to identify stocks that might fit your financial preferences. I'm going to be working on some of the stocks that you all, the listeners and the viewers, have written in and asked about. Just give me a little time in the future. I'll get to them. If you have a stock that you have a preference in, let me know what it is. Write into me. Let me know also what your name is so that I can call you out, and not call you out, but thank you on the air Some of you have different handles on your YouTube comments, and that's okay if that's the way you want to do it. But okay, thanks a lot, friends. Continue to write in. Listen for the disclosure, which is going to come up in just a moment. And if you're listening, listen to the disclosure. If you're watching, you can watch it. Thanks a lot, and I'll be with you on another day. Have a good evening.